So, deciphering fund fact sheets. Let us take a look at what we are all going to discuss today. The key information that is present in a fund fact sheet, the performance details, which is about the mutual fund, which is there in the fund fact sheet, the fund manager details, a bit about the fund manager's experience, a bit about other funds that he or she is managing, the portfolio data, where this mutual fund is investing, which sector, which stock, what percentage into which stock. All those details are mentioned in the portfolio data. Few key ratios and quantitative data to find out how well this mutual fund has performed. What was the engagement of the fund manager? What was the role of the fund manager? How well he or she has adjusted your return and given a higher return or not. All these things we will be taking a look at in this fund fact sheet while analyzing it. So how does a fund fact sheet look like? It looks something like this, right? So you have the name here at the top. You have a value investment style grid. You have the portfolio data here. Then you will be having the details regarding the fund, the details regarding the fund manager, the expenses, the objective of the mutual fund, a few ratios which will be mentioned here. Then there will be the sector allocation that will be mentioned here. Then according to SEBI, this performance table has to be there in each fund fact sheet which has completed 3 years and above. This SIP table needs to be there in each fund fact sheet for a layman individual to understand, just with an investment of 10,000 rupees, what would have been the corpus as on date, right? So it will be 1 year, 3-year returns, 5 years, 10 years, and since inception. Then finally, we have the riskometer at the bottom. So that will show again pictorially how much risk this fund will be taking and whether you can invest in it or not, right? So a layman individual can identify that. So 10 things that you need to know about fund fact sheets. That's what we're going to discuss. Let's start off with the first one. So you can find out the scheme name and the composition of the fund. That is where the mutual fund is coming from and where it is going to invest. So like, for example, here you can see Kotak Blue Chip Fund. So Kotak is the AMC name or the mutual fund company who is launching this mutual fund. Where is it going to invest? It is going to invest in blue chip stocks. So a large cap fund, open-ended equity scheme predominantly investing into large cap companies. So that's what you will be able to find out by the name, by the scheme name. You will be also finding out the composition. Okay, where this mutual fund will be investing. So a blue chip fund mostly invests into large cap stocks. Okay, so we have the second one, that is style box or the investment style grid. You can see that there are 9 boxes here. Okay, so we have 6 different parameters to look at. So on the right hand side, we can see the size, that is whether it is investing in large cap, mid cap, or small cap. On the vertical grid, you can see value, blend, and growth. So that is depending on the investment style of the mutual fund manager. So if the mutual fund manager or the mutual fund is going to invest by a value investment strategy, then the value box will be highlighted. If this mutual fund is going to invest through a growth oriented strategy, capital appreciation strategy, then the growth box will be highlighted. Similarly, if it is a blend of both, then the blend box will be highlighted. So you can pictorially see where this mutual fund is placed. So you can see that it is going to be a blend of value and growth stocks, plus a little bit higher towards growth. And mostly it is predominantly going to be large cap stocks, a little bit of mid cap as well, right? So that's how you can find out where this mutual fund is going to be investing in and what is the style of this investment. Finally, the third one, we have the fund manager names. If there are 1, if there are 2, all those fund managers' name will be mentioned here. The total assets under management of this mutual fund, the average AUM of this mutual fund will be mentioned. What is the benchmark for this mutual fund? The tier 1, the tier 2, all of it will be mentioned here. The allotment date or the inception date, the folio count, how many number of unique investors are investing in this mutual fund. All of those will be mentioned here. Okay. So this, you will be able to find out a bit about the details about the fund manager. It will help in building up trust. The total AUM, if it is very high, that shows that many people are interested in investing in this fund. That will again, give a trust factor. Finally, we also have investment objective. So that's the fourth point. The investment objective of a mutual fund needs to be matched with the investor's objective. Okay. So if the investment objective of the fund is to generate capital appreciation from portfolio of equity related securities from large cap companies. If that is the objective, so any investor who feels that this objective is understandable, if he or she also wants capital appreciation, wants to invest in large cap companies, then this is the fund for you. Okay. There is no assurance that the investment objective of the scheme will be achieved. This has to be made clear, like some sort of a disclaimer, because there is no capital guarantee. Then the mutual fund investor understands what kind of a risk he or she is getting into. So these are the 4 points. Next, let's move on to the sector allocation. So this is where you can see where this mutual fund is investing sector-wise. So you can compare it with its benchmark as well. So you can see that the sector allocation of this mutual fund is mostly towards banks. 23.52% is into banks. IT software, 12.64. Petroleum products, 7.33. Similarly, each sector will be mentioned here. All right. And if it is not that major sector, it will be combined with the rest. But you can see how your mutual fund is investing or where it is investing. Next, you can see here in the 6th point, the total portfolio, where this mutual fund is going to invest stocks wise or security wise, plus what is the proportion, what is the percentage to net assets that will be invested into this security is also mentioned here. So you can see here that this mutual fund will be investing 7.46% into ICICI Bank, 6.62 into HDFC Bank, and similarly so on for so many different companies from different sectors. You can see the top 10 holdings of this mutual fund issuer wise. So you can see ICICI Bank, HDFC Bank have been allocated the highest percentage. Reliance, Infosys come third and fourth. Similarly, you can also find out what we saw in the earlier pictorial version, the sector allocation of the percentage of net assets. Financial services have the highest percentage to NAV, that is 29.41, followed by information technology. So here you will be able to find out where your mutual fund is investing, and if there is any fluctuation in the NAV, you will be able to find out why, if that was exposed to that stock. Let's go ahead. So this was the SIP table that I was talking about. So this SIP table shows you in a simple term that if you had invested 10,000 rupees every month since inception, since last 10 years, since 7 years, 5 years, 3 years, and 1 year, what would have been your total amount invested? What would have been your corpus as of April 2023? What was the scheme return? What was the benchmark's return? What is the alpha that you have generated over the benchmark? All of these details will be mentioned here. Okay. So as you can see here, if this was a SIP of 10,000 rupees, which was invested since inception in this mutual fund, the total amount invested would have been 24,30,000. And the corpus generated or the value created would have been 1,25,89,360. So there is a since inception return of 14.28%. The benchmark returns is 13.80. There is an alpha of 0.49. That means this fund has beaten the benchmark. So the fund manager is doing his job. Okay. So that's how you read this table. So you understand just by numbers if it would have been a beneficial decision to invest here. Next, We have the product label and the riskometer. In the product label, in a very simple language, it is said for whom this product is suitable. So let's say it's written the product is suitable for investors who are seeking long-term capital appreciation and want to invest in equity related instruments of large cap companies. So only them will be a correct fit for this mutual fund. Only those investors will be a right fit. So that is mentioned here. Then the riskometer. So this is the fund's riskometer. So it is divided between 6 different phases. So low risk, low to moderate, moderate, moderately high, high, and very high risk. So wherever is the hand of the riskometer, that is what you count. So it's a very high risk fund. The benchmark is also very high risk. The second benchmark, tier 2 benchmark, is also very high. So according to the benchmark, this fund is also following that in being a very high risk product. If you want higher returns, then you can invest here. But it is making you aware. It is not going to keep it opaque. It's going to be transparent. Next, let's move on to some ratios. So you can see that there are portfolio turnover ratios. That's what we are starting with. You can see 13.51%. There is a portfolio turnover. So whatever stocks or securities were purchased at the start of the year, by the end of the year, 13.51% were not there. Or let's say that is the amount of turnover that happened. Bought more, sold away. That was the churn that happened in the portfolio. So if it shows a very high turnover, that might say that there were newer opportunities and the fund manager was actively managing a fund, right? Or it can also say that the decisions that were taken at the earlier, the decisions that were taken at the start of the year may not be that good. That might also signify that. Then we have beta. Beta, as you can see here, is 0.90. So beta is how sensitive your mutual fund is as compared with the benchmark. So if the benchmark moves up by 10%, if your mutual fund also moves up by 10%, then that means that you are at par and the beta is 1. If the beta is higher, let's say 1.5, then if the benchmark moves up by 10%, your mutual fund will move up by 15%. But if the benchmark goes down by 10%, your mutual fund will fall even further to minus 15%. Next, we have the Sharpe ratio. Sharpe ratio signifies how well your mutual fund manager has managed your funds, has adjusted your risks, and gotten you more returns. So, per unit cost of risk, there needs to be that amount of return that is made available to you. Otherwise, if you're taking risks more and more, but you're not earning that kind of a return, then it's going to be a problem, right? Hence, Sharpe ratio is one of the ratios that you look at. Then we have standard deviation. Standard deviation shows you how much this fund might deviate from its earlier mean of returns. So let's say for the past 10 years, it has been giving 10% return every year. But this year, if they say that the standard deviation is 3%, then from the last year's return, that is 10%, it might move up by 3% or move down by 3%. That is the amount of deviation that you can expect, right? So what does this signify? It signifies that if the standard deviation is too high, then the mutual fund does not have consistency. It might be very risky. It might be volatile. You're not investing in a mutual fund for its volatility. You're investing in it so that you are getting diversification of risk and stability. So a low standard deviation figure will be preferable. A high Sharpe ratio will be preferable because per unit of risk, you generated higher amount of returns. That is great. Beta is again on a case-to-case basis. Portfolio turnover again is on a case-to-case basis if the returns have been achieved. Then we have PE ratio and PBV ratio, that is price to book value, price to earnings, and then we have the IDCW yield. Okay, we are coming to that in the next slide. Let's see the 10th point. We'll see that there is a minimum investment that will be mentioned here. So in this mutual fund, initial investment is minimum 1000 rupees. And the ideal investment horizon, what should be the kind of ideal investment horizon of investing in this mutual fund? So it says 5 years and above. The entry load, exit load, and the criteria for the exit load. So it is 1% for, if you're redeeming the whole amount within 1 year. But if you're just redeeming 10% of your original value, then the exit load is nil. After 1 year, the exit load for the full investment is nil. The total expense ratio, if this mutual fund has been invested through a regular route and a direct route, will also be mentioned in the fund fact sheet. Now let's take a look at a few ratios. Beta, as we saw, the measure of investments volatility vis-a-vis the market. Then we saw how to calculate it. Beta of greater than 1 implies that the securities price will be more volatile as compared to the market. So we calculate it by funds return minus the risk-free rate divided by the benchmark return minus the risk-free rate. Then we have the Sharpe ratio. It's also the measure of risk-adjusted returns. How do we calculate that? Return of the portfolio minus the risk-free rate divided by the standard deviation of the excess return. That will give you your Sharpe ratio. Standard deviation, like we had discussed, it will be how well your standard deviation will show you how much it will deviate from the earlier year's return, right? So based on that, you will be able to find out whether your mutual fund will be consistent or not. PE ratio, price to earnings ratio, is the relation between the company's share price and the earnings per share. So what is the amount that the market is willing to pay for this company's profits or the earnings is what is calculated by PE ratio. So for the price, earnings should be higher. If you are receiving a lot of earnings and if you have to pay a very less price for it, that is a considerably better scenario. Hence, PE ratio should be on the lower side, right? Then we have the PBV ratio, that is the price to book value ratio. It compares the company's market value to its book value. So if the book value is higher and the price of the company is lower, that is a likely great scenario, so that you can buy this stock or this security at a lower price, and then finally it will achieve its real book value, right, in the coming time. So you are buying it undervalued. If the price is higher and the book value is lower, that is known as the overvaluation. Then we have IDCW, income distribution cum capital withdrawal. So this is dividend yield, which was earlier said. Dividend yield is the financial ratio that shows how much a company pays out in dividend yields each year as related to the stock price. So let's say 100 rupees was invested, and for that year, what was the dividend yield? What was the amount of dividend that was given back to the investor? So people who need income, who want higher and higher income, they will opt for a high IDCW yield. But people or investors who want capital appreciation, they might look for a low IDCW yield. They might look to invest into a growth style mutual fund, which has very less IDCW yield, so that their capital appreciates over time. They don't want any kind of an income or dividend which needs to be coming to. Okay.